All right, everyone, welcome. Today we're going to get into something that's really crucial, not just for our course, but for anyone earning income in Canada. We're talking about the 2025 Enhanced Canada Pension Plan contributions. Now, you might look at this and think, wow, this has gotten complicated. And you're right, but there's reason for it. The goal is to give us all a much healthier retirement income down the road. So our job today is to cut through that complexity and make it crystal clear.
So I've put this little explainer together to walk you through all the numbers and, more importantly, what it all means when it comes time to file your taxes. Let's get right into it. Here's our game plan. First, we're going to break the CPP down into its three main pieces. Then, we'll build the whole calculation up, step by step, looking at the old base part and the new enhanced layers. And once we have our final number, we'll get into the really key stuff, how it's treated on your tax return, and the special rules for anyone who's self-employed. Okay, let's get started. The absolute first thing you need to get your head around is that your CPP contribution isn't just one number anymore. You really have to think of it as being built from three separate blocks. We're going to stack them up one by one. And here they are. You've got the base contribution. That's the part that's been around forever. Then you have the first additional contribution. And the brand new piece of the puzzle is the second additional contribution, which you'll often hear called CPP2. If you can understand how these three work, you've basically mastered the whole thing. So let's start from the ground up. We'll begin with the foundation of this whole thing, the base contribution. This is the biggest piece and probably the one that feels most familiar. The calculation always starts with what's called the basic exemption. In 2025, that's set at $3,500. Now, what this means is pretty simple. You don't pay a single cent of CPP on the first $3,500 you earn all year. We always subtract this amount before we do anything else. Next up, we have a ceiling, a cap, which we call the year's maximum pensionable earnings, or you'll just hear it called the YMPE. For 2025, that's $71,300. This is the highest income level that gets used for the first two parts of our calculation, so if you make more than that, these first two contributions stop going up. They're maxed out. All right, so let's look at the actual formula. You can see it right here. The base contribution is simply 4.95% of the difference between that ceiling, the YMPE, and our floor, the basic exemption. So basically, it's just under 5% of the income you earn between $3,500 and $71,300. And when you plug the 2025 numbers into that formula, what do you get? You get a maximum base contribution of $3,356. Go ahead and lock that number in your brain. It's our foundational block. Okay, so we've got our foundation poured. Now it's time to add the two new layers on top, the parts that make the CPP enhanced. Let's look at the first and second additional contributions. Now, this is where things get really interesting. Take a look at these two side by side. The first additional contribution is just a 1% charge, and it's on the exact same income range as the base part we just did. That gives us a max contribution of $678. But look over at the second contribution, the CPP2. The rate is much higher, 4%. But, and this is key, it only applies to a brand new slice of income. The money you earn between the old ceiling of $71,300 and a new ceiling of $81,200. This new part tops out at $396. Okay, I know this slide looks a little dense, but don't worry, let me guide you through it. This is pulled right from the source calculations. See how it's broken down? Item 1 is our base contribution, Item 2 is that first additional piece, and Item 3 is the new CPP2. You can see exactly how the math works to get us to those three magic numbers we've been talking about, 3356, 678, and 396. This right here is the engine room of the whole thing. All right, we have all three of our building blocks now. We've got the foundation and the two new layers. So let's do the easy part and just assemble them all together to get our grand total for 2025. It's really just a simple addition. We start with our base, that 3356. Then we add the first enhancement of 678. And finally, we tack on that new CPP2 amount of 396. And there it is. The total maximum an employee will contribute to the CPP in 2025 is $4,430. So if you earn $81,200 or more next year, this is the total amount you can expect to see come off your paychecks over the course of the year. Now, knowing the number is one thing, but for a taxation course like ours, knowing how it interacts with your income tax is everything. So let's pivot to the tax implications and the special rules for all you aspiring entrepreneurs out there. Okay, pay close attention here because this is absolutely critical. The government treats the different parts of your CPP contribution, well, differently. That big base contribution of $33.56 gives you a non-refundable tax credit, but the two new enhanced parts, which add up to $1,074, are treated as a tax deduction. That means they reduce your taxable income dollar for dollar. This is a huge distinction, and you have to remember it.
This is a question I get every single semester. What happens if you run your own business? What if you're a sole proprietor? The rules change a lot. The fundamental rule is this: if you are self-employed, you are responsible for paying not only your own share that we just calculated, but you also have to pay the employer's matching share. For all intents and purposes, you pay double. This table lays it out perfectly. A self-employed person pays their own $44.30 and they pay the employer's matching $44.30 for a grand total of $88.60. Now, their own share gets that mix of a tax credit and a deduction we just talked about. But here's the good news for the business owner. The entire employer share, that second $44.30, is considered a business expense and is fully deductible. Okay, I know that was a ton of detail. So let's just take a moment and do a quick recap of the most important points from all this. The stuff you really need to remember. So here are the big takeaways. First, your CPP is made of 3 building blocks: base, first additional, and the new CPP2. Second, each of those blocks has its own rate and applies to a specific slice of your income. Third, and this is crucial for your tax returns, the base portion gives you a credit, while the enhanced parts give you a deduction. And finally, if you're self-employed, remember, you wear 2 hats, and you pay both shares. So I'll just leave you with this final thought to chew on. Now that you can actually take apart your CPP contribution and you understand exactly how it affects your taxes, how does this change the way you think about your own financial future? It's not just some random deduction anymore, is it? It's a complex and much bigger investment in your own retirement. Think about that.